Hey guys! Welcome to my YouTube channel. The 2 Golden Rules Financial Market. With these 2 rules, stay alive in the trading market with us. Two Golden Rules. Money management and risk management. 2 golden rules of the capital market that will make you successful and help you stay and grow in the market without becoming a margin call. A lot of novice traders often would not pay much attention to it and neglect it by only focusing on gains and technical analysis. In order to make a profit in the capital market and not lose our capital, we must not violate these 2 rules. To survive in the market, you must have a trading plan and stick to it. Mastering these 2 rules will allow you to manage your risks and minimize your losses. Both rules serve the same purpose, which is achieving long-term success by preserving capital. Each trader should know what is risk and money management in Forex and crypto trading. What is money management? Money management is a vital element of trading the most volatile financial markets like Forex and cryptos. If you use it in an intended strategic fashion, solid money management can be used in an offensive and profitable way. The goal is basically to maximize the profits while protecting the fund against any loss that could incur. Money management focuses are effectively allocating and protecting trading capital. This is very important. Most traders may have gone over the feeling of losing all of their money. Though the trading strategy was tested over a long time with really good results and they might find it the best trading strategy in the world. So they should know that without good Forex and cryptos money management practices, they'll most likely lose all their money and be removed from market trading. What is risk management? In essence, Forex and crypto risk management involves identifying, assessing and prioritizing currency trading risks, and then engaging in the use of resources to minimize, control and monitor trading losses, and to maximize trading gains. The best way to protect the capital from getting liquidated is by fixing a particular dollar amount for every single trade, and not crossing that number whatsoever. How many % can you risk for your trading capital? This number represents the amount of money you are willing to lose if the trade goes in the opposite direction. Money management helps to preserve your capital, and risk management help to maximum gains. These 2 rules help you maximize your profits, minimize your losses, and grow your trading account. If you want to get maximum gains, you should control risk management. The capital market is based on probabilities, and we manage risk based on probabilities. This market has no rules. Make your own rules and follow them. So now, imagine the market is moving downtrend. We have a level of support, the candles hit her several times in a descending triangle pattern. Based on this, we decide to take a short position after closing this candle. For example, with 5% of the capital, we take a short position without money management and stop the loss. When we do not set a stop loss, it means that we have invested all our money in this transaction, and in this case, the amount of risk has no meaning. After the trade moves opposite our direction, we hope the price will return to the entry price, and get out of the short position. Novice traders after their position is at a loss, it is possible that they will exit with a large loss due to the fear that the market will not return. How annoying and damaging it can be for future trading decisions to close all these losses in one position. Imagine that some traders who opened positions in the opposite direction had the martingale trend in the same direction. The important thing is that these people increase the risk to compensate for the loss and lost capital. And without money and risk management, they margin call their account into several positions. It makes them open the next position in the market with a sense of anger and revenge. Of course, there is a type of money management without a stop loss, but it has its own rules. We did not mention this in this episode. Stop loss is for traders who care about saving their capital first and then making a profit. Avoid this type of trade when you don't have sufficient knowledge of no stop loss rules. And now, an example with 2% risk capital management. The 2% rule is a money management strategy where an investor risks no more than 2% of the available capital on a single trade. It will help you to avoid the risk of being eaten by a shark, meaning that a few large losses can reset your capital. Alexander Elder used this algorithm. I'm pretty sure everyone has heard of the stop-loss feature before. The main question is, do you use it? Stop-loss closes your position when the price drops to a certain price level, so you don't have to worry about sudden moves. Stop-losses will prevent your trades to dump to levels you don't want them to. You cannot control your risks. It means that you may lose funds if mistakes or greed take over you. Without an effective risk management strategy, your trading process turns into gambling. Finance transactions are risky. The main thing is to find your risk limits. It's time to take a look at the risks of making a wrong decision. First of all, you need to decide how much percent of your money are you willing to risk on a trade. This number represents the amount of money you are willing to lose if the trade goes in the opposite direction. Choose your risk according to your trade personality. Each trader will have a different way of managing capital, formed from knowledge and their own trading experience. Part of the trading personality is the level of loss tolerance in each position or each day or each week of positions. Risk only what you can afford to lose. Do not risk more than you can afford to lose. After you know your risk, you can choose between 1% and 3% of your risk, which is a reasonable risk as a fixed risk. According to my trading personality, I tolerate 2% of my lost capital, so I choose 2%. I think 2% per trade is good enough. This means that when I take a stop loss, only 2% of my total trading capital should be lost. It is impossible not to lose and make a profit. This is part of market trading. With this constant risk, we reduce the loss of the trading account. This type of risk management is for traders who have opened positions in the direction of the trend or against the trend of the market or in a trading range market. Their risk management is constant. In the worst case, we lose 2% of our total money. Since the amount of our risk is known, we use stop loss. Our risk is controllable. Here I mention another type of risk management. We can enter these risks as fixed and stepped risk. If you want, we will explain it fully in the next episodes. We do not enter positions where the risk to reward is below 1:1. The risk to reward should be 1:1 to enter the position. This means that your profit potential must be equal to or greater than the potential loss. Let's suppose our account size is $1,000. Our position size determines what percentage of our capital will be lost if the price hits our stop loss. If we risk 2% of our account size on this trade and get stopped, we will lose $20. If out of 10 positions with a risk of 2%, 6 positions fail and 4 positions are profitable, with a bonus of 2, we are still profitable. And if you lose 6 positions and do not open the 7th position, 12% of your total account is a loss. The average calculation of the probability of profit and loss should be approximately 100 positions and above. This example is for a fixed risk of 2% in 10 trades. The same example if it is for risk above 5%. If we lose 6 trades in a row in a bad trading area, which is likely to happen to everyone, we will lose. Because our loss has reached 1/3 of our account, we may not enter the 7th rank because of fear. In this case, we lose 30% of our total account. Avoid creating a psychological burden. When trader selects a reasonable risk tolerance, they will not suffer from psychological impact after a loss. If you choose a high risk tolerance level, after each loss, the trader will be easily afraid to enter the order, or the psychology of revenge will lead to a big order. The lack of discipline and post, indeed, it may be worse. Avoiding account losses to a level that is hard to recover. Strictly money management will keep traders in the safe zone of trading. Stop loss is really important. It is difficult to recover the original amount of trading capital. If you have big trading losses, the higher the amount of loss, the compensation is also higher than the amount of loss. According to the table, know the importance of money management. This table shows the percentage of the profit needed to recover a loss. As you may have noticed, the table depicts the sum you will need to recover if you lose your capital. This table means that once the trading account has been reduced, it is much more difficult to recover the losses. If you have lost 50% of your initial capital, a trader needs to earn a profit of up to 100% for the remaining capital to return to break-even. This ability is extremely unlikely. For example, a trader had a $1,000 deposit. As a result of losing trades, only had $500 left. The trader needs to increase the sum by 100% in order to recover the loss. The main difference between a winning and losing trader may not be their trading strategy, but also the way they deal and manage open positions, unprofitable trades, and stop losses. That is, how strictly they follow the best practices of money management. Some traders decide not to set a stop-loss order, trying to avoid a drawdown. Alas, this strategy complicates risk management, as the drawdown may deepen. Maintain a passion for trading. Large losses and quick losses also lead to another psychological consequence, which is to reduce traders' passion for doing trading transactions, besides reducing money. This is the most important factor that makes traders leave the market soon. Don't forget that the key to successful trading is money and risk management. In conclusion, when investing in or trading in the Forex and crypto market, the leading factor that trader needs to remember is to ensure safety for the capital. Once an effective money management solution is available, traders can survive and seek sustainable profits. This is a Kelly formula for money management. The total capital multiplied by the risk in percentage is the passive number, and stop loss in percentage multiplied by leverage multiplied by a size position. Ensure your capital with funnel capital management. This type of capital management means that we have a constant risk, but unlike the previous example, after a certain amount of loss, we cut our risk in half. And so it goes on. Don't worry, I will explain everything. In this case, you can open 6 positions with half the risk. If you take the stop loss, you will have the risk again, which will be 25/10. It means that the risk is halved. If it faces a loss again, we will have it again. With this method, if you open 12 positions, you will just lose 3% of the total capital. When you fall into a losing cycle after this, you should stop trading. According to the trading program, you can determine the percentage of your loss on a daily or weekly basis, which depends on you. Determine a specific loss point that the trader will end trading on that day or week. The maximum percentage of capital that the trader loses on the whole account. If this happens, the trader stops trading and switches to reevaluate his trading system or switch to a demo account to rehearse. The first reason is to avoid the psychology of revenge on the market, resulting in disruption of trading plans. The second is the market may be in a chaotic period or not in line with your familiar trading style. So, stopping for a while helps us to pass that stage. Relaxing your mind will also help to improve the efficiency of trading later. Emotions have a big impact on the way we trade as well as the profit or loss we may earn. We often hope that it will turn back to profitable again instead of quickly exiting a losing trade. This mixture of fear and greed is what ultimately separates the bottom line of professional traders from that of amateurs, and its negative impact can be prevented by learning the basics of money management in Forex and crypto trading. In the next episodes, we will learn more about market psychology. To preserve your capital and earn maximum profit, you need to manage your risk and minimize losses. It's hard to identify what will happen on the markets, that's why you should be careful and manage your trades properly. The difference with the risk of 2% is that we lose 12% with 6 positions, but in this method, we lose 9% of our total capital with 21 positions. With this method, we have more opportunities to open many positions. The important thing is to reduce the risk when our account is lost. When we are profitable, we need to manage and add risk. Therefore, if we earn a profit, we add a certain unit of risk from the profit received, and when our account is at risk, we reduce the risk. These techniques with smaller trades, and after you master them, you can scale the trades. Risk management and money management, 2 defensive strategies, are meant to preserve capital. Is a key element of the success of trading.